But there are oral tax provisions on oral trust where tax is at maximum marginal rate, and he can assess tax, even also assess tax directly in the hands of beneficiaries. Because as you know, for trust, primarily they say legal representative is the trustee. But there is no bar on the income tax to recover tax from the beneficiary also, which we will just see in a short while. As I said, these provisions are just 161, 164 which I mentioned. What they deal with is pointed out in this slide. These are all on discretionary trust. So discretionary is at the discretion of the trustee. Specific trust. Now a specific trust is where the trust very clearly says that they have no discretion. Trustees have to give away income in a specific manner and specified issue. That's called specific trust. But under 161, the important thing is the liability to tax of the trustee is as much as that of a beneficiary. So suppose beneficiary is an exempt entity, can you argue that the trustee's liability cannot be more? Just a exposure, because that is what was argued in this ILFS trust matters. You know, there were beneficiaries of mutual funds, and one of the arguments which was taken was that ultimate liability of trustees can't be more than that of the beneficiary. So there was a huge litigation, largely relying on 161, that liability of the trustees will be assessed in like manner and to the same extent as beneficiary. So basically saying my liability stops as that of the beneficiary. Business income is always taxable at maximum marginal rate, because they do not want trust to get into this adventure of business. Purpose of trust is probably not so much to get into business, that's maybe the thinking. Trust has to take a separate PAN, as you all know, and on that basis the TDS credit will be given. So here there is no issue about TDS credit, because the trust has a PAN and credit has to be taken. So for as soon as the trust is formed, people first should take PAN and then the bank account opens, as we all know. Without PAN, nothing happens now. So trustee, then PAN and then bank account and other things. These are the differences between discretionary, determinate and discretionary trust, which I have just discussed. So you can just have it's a little detail, so I'm not going more into it. Now this is what I would want to discuss a bit, because as I said, that trustees are holding here. Sorry. See, trustees are holding shares or assets for the beneficiary for the beneficiaries. So when the trustee receives, suppose, assets or something in the trust, does 56(2) apply? That's a big question, because trustee is not receiving in his own capacity, but he is receiving for the beneficiary, and there is an obligation. So can you say that there is 56(2) contestable? Similarly, for the beneficiary, now let's look at beneficiary. Now beneficiaries have a right in their trust, may not be fixed right, but they are beneficiaries. So when trustees hold for beneficiaries, and beneficiaries are pre-existing right in the trust. So when distribution happens from the trust against this right, against the beneficiary, so can you say that 56(2)(10) does not apply to beneficiary, because they already had a right? So it is not without consideration. My right is a consideration against which I am receiving, something which you can look at and argue if questions come up. And 56(2)(10), by and large, the appellate authorities have really read it very well, in the sense they have not taken the entire gamut of situation and decided matters, and not simply distributed. By and large, if you read any decision on 56(2)(10), they are pretty widely worded and very comprehensive. So a lot of guidance can come from there. Trustees receiving assets and beneficiaries receiving again their share. Now a very important decision here, which I have mentioned, is commonly cut out. Now what was commonly cut out? Basically that decision was that out of income of the discretionary trust, certain amount was paid to beneficiaries, and that beneficiary has paid tax. So department said that trust said no, we do not pay tax, beneficiaries have paid. So it laid down the Supreme Court leading decision that department has an option to tax either beneficiary or trustee. There is no ban in department to tax beneficiaries. They've also discussed section 164 in detail, saying that 164 is not a code in itself, it's not a charging section, and it does not in any way say that we cannot tax the trustee. So all these were discussed, but ultimately, even having done so, they have an option to tax. Ultimately, what happens is that same income cannot be taxed twice. So that is what this David Joseph tells, that once the income beneficiary has paid tax, and that can be proved. On the principle of double taxation, you cannot again recover from trustee, but to say that trustees cannot be liable because beneficiary of fund return is not a strong argument, and that is where this Kamalini cutout one should always keep in mind before taking a decision that they have done it, so I won't do. Keep that in mind and ensure that we have adequate proof that at least one party has paid tax. This is a very interesting decision. There was a private trust, and that trust received grants. Grants were put in the trust. So department said that no, this becomes taxable under 56. So this is 56 grant is not at all a property. 56 too. If one were to read, it has very limited definition of property: land, building, shares, similar to wealth tax. So it doesn't say inclusive, it says property means. So anything beyond that is not property. So if the brand is put in the trust, it is not covered by 56 to 10, and it's not even a business purpose in a 28 code, etc. So the important thing is, remember that property is very restricted for 56 to, everything cannot be called property, unlike capital assets. See, capital asset is defined widely, capital asset includes, whereas property means the difference. And lastly, though it's not directly on succession, but I wanted to just touch upon undivided family, because some of the questions about succession also relate to my HUF, etc. So, to just give a brief, again, HUF nowhere defined as usual, it's not defined, but it is a person under the Income Tax Act. And as we know, HUF is a group of persons. There is a common ancestor, his lineal male ascendants, their wives, unmarried daughters. Now, of course, married daughters have a share, and their children. So it's basically a family consisting of ancestral, lineal ascendants and descendant family members. We have two schools, Dayabhaga and Vitakshara. Dayabhaga is only in Western and West Bengal and Assam, basically matriarchal family. And Vitakshara is other than that, patriarchal family. And again, what is HUF? Courts have held that there is no definition of HUF anywhere. Even if you read Hindu Succession Act, no HUF is defined. So you go by whatever is understood a common Hindu law. If it's declared as HUF, then basic attributes of HUF and it's HUF for the tax purpose also. Because typically HUF is a separate entity, so people always are keen to have an HUF so that certain assets can remain in HUF, subject of course to them actually being part of HUF, not just putting anything. But HUF is a good way of parking your assets, provided they are ancestral assets. To start with, HUF must have some ancestral assets, some ancestral property to show it's jointly owned, and that is how the HUF comes into being. That's how the origin is. HUF's origin is ancestral property. Later on, of course, it acquires, but existence comes like this. As I said, HUF, as I mentioned earlier, HUF covers not only Hindus but Jain, Sikhs, and Buddhists are also covered under as governed by is treated as HUF for all purposes, and there has to be minimum 2 related family members. Basically, one male is enough to start an HUF. Again, I said to start there has to be one male member. Later on, it can continue even if there is no male member. Yeah. Then, as you know, HUF comprises of male member and his branch.